Okay, so our next speaker has travelled all the way from the States. He's the managing director of a relatively new company called Life Science Ventures, and he's working very closely with one of our members, Nathan Nagel of Oncology Pharma, and he's going to be talking to us about early stage investments, and he has about 18 years experience of strategic financing, of venture capital, and so on. So delighted to welcome you all the way from the States. Thank you, Andrew.
Well, I want to thank One Nucleus for the opportunity to actually come up and present from before you folks today. Early stage investing, a little bit of a different talk from what the Baroness delivered here, but early stage investing in its heart is really elemental, and the key thing is understanding what elements actually make up a fundable deal. It's my hope that through the conversation today, it'll stimulate the conversation amongst yourself and your colleagues, that you'll walk away and start to think about how you approach this, either as an entrepreneur and how you develop your opportunity, or as an investor in making the decisions that you do. The first thing I'd like to share with you really some information about what are the commonly considered early stage investors. And these are the angel groups as well as venture capitalists, both of which, quite frankly, have some pretty significant limitations. The average VC only reviews 10% of the total deal flow that they actually see. It's a relatively small amount. They're only, in fact, investing in about 1% of the deal flow that they see. And what's happened now is that most VCs, in fact, are investing about 2/3 of their dollars into later stage opportunities. So that's leaving 1/3 of their investment dollars going into the very early stage stuff. And what we see, in fact, then, is that venture capitalists are only deploying about 3.6 million pounds on average into a first round investment, whereas angel groups, on the other hand, are doing about 120,000 pounds. That's really the funding gap that we all seem to experience at the early stage space. The good news is that angels are deploying about 75% of their investments into that space, so they're clearly a source of potential investment for those opportunities. Both angel groups as well as the VCs are heavily targeting biotech and medtech, and will continue to do so into the future, largely because of just what the Baroness was talking about. These are real opportunities, and when we actually can capture these from a market perspective, it's something that can create value for both the financiers as well as for the larger community. The key points in terms of takeaways today, I'd like to share with you really what, from an investor's perspective, are the elements of a fundable deal. I want to talk about financial intelligence, and in this case, there's a difference between cash and value, in fact, is greater than just sheer cash. I'll share with you a little bit about the market today, both in terms of what we've come through as well as where we're today, and really what are some of the risk factors. And then switching at the end is about considerations for the other side, really looking at the investors and asking why and how you invest in this space. The elements of a fundable deal, and you see here, this really isn't a prioritized list. So a sophisticated investor is going to look at your opportunity, and first and foremost, they want to see that you have a best-in-class team, folks that really have sector knowledge. They want a product, not a technology necessarily, but a product that has competitive advantages that allows you to go out and capture share in the marketplace. It has to be a market that's not huge. It doesn't have to be 50 billion pounds. Everybody thinks it needs to be gigantic. It needs to be right-sized based on the opportunity that you've got to be able to go out and capture share. And then understanding the stage of your development is really critical for you as an entrepreneur, because it's going to enable you to go out and target the right type of investor at the right time for where you are developmentally. And lastly is about having a supportive ecosystem. And this is a very, very big challenge the world over, quite frankly. You need to have access to the right type of talent to develop the opportunity. You've got to have access to infrastructure. You've got to be able to have public policy that, quite frankly, wants us to develop our opportunity where we are. And then you've got to have the investors. All of this is what really needs to be in line to get a fundable company. So although it's elemental, it's not necessarily an easy thing. I really do believe the greatest strength that an individual can have, and particularly as an entrepreneur, is recognizing their weaknesses. Understanding this is what will empower you to really form a team around yourself that are going to be strong where you might be weak and push through when things get very difficult for your opportunity. The critical aspect of this is that investors look at this. They want to appreciate that you understand where you add value and where the rest of your team adds value. And not only will they appreciate it, they're going to value this in terms of their investment. So the team, I put up here that it's a love affair, not a fling. And the reason for this is that it's a long-term relationship that you've got to have with a startup. They last a very long time. You've got to have a patience, have a passion for what you're doing. So when you wake up at 2 o'clock in the morning, you're thinking about the right things in terms of developing your opportunity. These have to be people also that have deep sector knowledge in what they're dealing with. I need a CEO. Very often folks come to me and say, I need a CEO because I need to raise money. And so they go and source somebody that's got a blue chip background and it's got a Rolodex. It's important, don't get me wrong, in terms of obviously sourcing the capital that allows you to develop your opportunity, but pick somebody that really understands your market, understands your product, understands what they're doing when they go out to communicate your message and story to the marketplace, to the investors, so that they can secure the right type of funding to develop your deal forward. Boards are something, whether it's a scientific advisory board or it's a business board, are something that largely are an oversight for early stage companies. They see them as something that a more established, larger developed organization is going to need. But quite frankly, I would encourage you at the earliest stages in developing your opportunity to get a board in place. Get a scientific advisory board, a business advisory board, board of directors. These are folks that are going to be able to help you navigate what might be some real obvious pitfalls. Get away from those kind of things so that you can develop your opportunity forward in the best possible way. In addition, beyond just helping you with the basic business stuff and the basic scientific stuff, they can really help you when you're going out and having to source additional talent, access additional markets, get into distribution channels, and help you in the all-important fundraising. Servants with many masters, everybody has these. These really are the folks that are behind the scenes that we don't always see. They're going to be the solicitors. They're going to be your accountants. They're going to be the marketing groups, the CROs. These are folks that you need to not only obviously have, but you need to have best in class. And these are people that, beyond just what you may have contracted them for in terms of delivering the work product, you want to reach out to them for what else they can bring to you. What additional value can they deliver? So when you're challenged with trying to find the right type of PhD to help you on developing your technology, can they source that individual for you? Can they introduce you to a prospective distribution partner? Can they introduce you to investors? So how do you know what you have? You've got a great team, but how do you really know what you have? And there's a critical difference between a technology and a product. A technology really is something that, from an investor's perspective, is going to enable something else to go to the market. But at the same time, it's dependent upon others. So it's a challenge in terms of getting into the marketplace. On the flip side is really a product. This is something that can serve as a substitute or a complement to what is already in the marketplace today. It's largely independent and can enter the marketplace on its own. And this is a very important thing in terms of what you're looking at. So if you take an iPhone as an example in the iTunes store, the iPhone is largely just a technology until you pair it with that iTunes store, because now you've got a product that can go to market on its own. And the key thing is ultimately being able to have competitive advantage and being able to set up barriers to entry. The most common forms that people think of are intellectual property. They're all well and fine, but the ultimate competitive advantage that you want to have in your product is market share. And that's something that you'll think about as you move forward in the development of your opportunity. Because if you own the customers that are out in the market, that's very, very difficult for somebody else to take away from you. So we got a great team, we've got a great product with competitive advantages. Where do we really fit in terms of the market? So as early stage scientists, you may look at it and say, I need to get in front of investors because I've got a particular problem it's personal to me, so therefore I'm going to extrapolate that it must be a huge problem out in the marketplace. But before you do that, really work to understand what the market opportunity is before you get in front of investors. What you don't want to do is just say, it's my personal opinion, so therefore it must be big. You need to go out and do the research in the marketplace, understand really what the true size of the market is that you're going to be participating in, and treat your analysis and your data gathering on this just as seriously as you would the science, because the business people behind the money are going to want to know that you know it and appreciate the real market opportunity you're going after. Understand market relevance here, and what we're talking about is people will come and say, I've got such a great technology or such a great product, I've got competitive advantages, nobody competes, I don't have a competitor out there. Don't ever say that to an investor. It's largely unbelievable. Competition is really on a spectrum, and if you can't find your competitor, I would argue you haven't defined the spectrum large enough. You want to identify the competitor because, first of all, you're going to be credible then to the prospective investors, but on top of that, these competitors can serve real value for you as you go to develop your opportunity. They may ultimately serve as a distributor of your product. They may ultimately acquire your opportunity. In fact, they might even decide that they want to invest in what you're doing. So understand the competitive marketplace. And then recognize your position within the market, and that is, where is the market developmentally? There's a natural life cycle associated with any market in terms of growth, maturity, and eventual decline. You don't want to be getting in at the wrong time on the market. Also, how is the market positioned? Is it highly fragmented, highly concentrated in terms of the consumers, in terms of the competition, et cetera? recognize what that is before you go out and really start to try and push forward with an overall opportunity. So, all right, we've got a great team, we've got a great product, and now we've also got the market really defined. It's fantastic, so show me the money, right? I want to get out there, I want to raise the money. It's important that before you go and start putting yourself in front of investors, you slow down, recognize that the money that you're looking to raise, it could be coming from pensions, it could be coming from police, it could be coming from teachers, it could be coming from a variety of different sources that have worked very long and hard to earn that money. Even that individual angel that you're talking to. Respect the fact that people have worked for that and the money that they're looking to deploy. It's a real trust that they're putting in you. Seek value over cash. The critical thing here is you want to try, ideally, and target investors that have knowledge in your space. Can they partner with you in accessing distribution channels, in accessing additional markets? Can they potentially come onto your board and help you navigate the vagaries of developing your opportunity forward? Appreciate the risk, time, and return also associated with your opportunity. You have to have defined what the risk is, which means you know it, really, that you've mitigated to the best of your ability, and that you're able to convey to the investment marketplace how you're going to manage risk going forward. And then lastly, know yourself and know your investor. Understand where you are developmentally in a stage, target the right investor at the right time, and recognize that you can't go out just to raise an individual round of funding. You need to understand the total level of capital intensity associated with your opportunity so that when you can present it to an investor, you can show them how not only are you looking to take in their investment today, but that hopefully you'll be able to return their money and then some into the future. And then lastly, be creative. Everybody thinks that I've got to go out and sell equity in order to raise money. There are alternative ways by which you can do it. You can look at different structures around debt. You can look at quid pro quo by participating potentially with a competitor to help develop your technology. Look very creatively in terms of how you finance your opportunity. So where do we really fit in the overall financing spectrum? On the right-hand side of this, left-hand side for you folks, what you're really looking at is a pretty highly concentrated area of investors in terms of founders, angels, the government, and value chain. Now, the angels are a pretty common source in terms of what people will think of. Government is something that isn't necessarily all that attractive because it can be long and it can be somewhat arduous in terms of filling out all the paperwork to get those kinds of grants. But they are, in fact, just that, grants of capital oftentimes which are non-dilutive to the investment. So you want to seek this out very aggressively. Also, your value chain. Later stage, you're going to look at your value chain in terms of getting cash from your customers to be able to funnel back into your R&D. Early on, what people don't think about oftentimes is their value chain in terms of going upstream. What about going to the suppliers of the raw materials for your products and saying, I've got this great product, you have a vested interest in this, why don't you invest in what I'm doing? Why don't you give me free product and I will give you something in exchange? Look into your value chain and be creative about how you actually raise the money. You can look towards venture capital and corporates. Again, they're going later stage, and that's not really going to be changing too dramatically right now. But look at venture and corporate money as well as private equity later stage. The challenge with VCs and corporates when you get into them, oftentimes the money is going to be relatively expensive. So they're going to drive valuations down, and they're going to have relatively onerous terms. There's a point in time where if you're developing something that is truly high growth and you need that kind of extensive capital, you're going to take them on board because they also bring value in terms of networks and other things. The public markets at the bottom, that's something that just becomes kind of tantalizing for folks to think about, not really applicable in terms of right now. When raising funds, remember, you really do have to be prepared. You have to go out and pitch to people as though it's your only chance that you're ever going to get to sit in front of that investor because oftentimes it will be. You have to explain the risks and communicate. Again, it means you have to know what the risks are yourself, but explain them and communicate them. Even though you might be a little bit afraid to share what the risks are associated with your product or your technology that you're developing, if you don't share those with the investors, they will find out and it will be the death knell of your deal and of your reputation if you haven't shared those. Communicate and persist. You have to really, really push hard. Raising a round of funding oftentimes will take at least 9 months. That's an awful long time, so you've really got to have that follow-through, that persistence, and communicate with them. Follow through with all of your investors. Whether you get a yes or a no, ultimately push all the way through to get a result. And then recognize reputation both precedes and follows you. So you have to enter that room with that investor and think as though your reputation is the most important asset you have when you walk in the room, because the reality is, it is the most important asset you have when you walk in the room. It needs to be the most important asset you have when you leave the room. So what's it like out there today? Well, first of all, the VC industry contracted pretty severely over the last couple of years. I don't know that I'm telling anything new to this crowd. However, this year, a positive note is that there are more funds that have raised less capital overall. The positive aspect of that is that means that these are smaller venture capital funds, and it's going to necessitate, in fact, that they invest in earlier stage deals. IPO exits tripled in the third quarter of this year, year over year. The positive aspect there is that the markets are starting to loosen up a bit, and U.S. early-stage VCs are producing the best returns. Hopefully, that means that additional limited partners, those investors in the venture funds, are going to be coming off the sidelines with their capital and deploying it in this space. Corporates are also increasing participation, so that too is a good thing. The biggest risk profile that we're dealing with right now is global financial brinksmanship. So in the United States, we've got the self-imposed fiscal cliff, which is really kind of a dumb thing, but that's our politicians back there. And over here, we've got the Eurozone crisis in terms of Greece and Spain and Italy and the like, all of which presents real risk into the marketplace. So lastly here, just to kind of switch for a second, for the other side of the table, really looking very specifically at the investors. In as much as we understand that there are elements associated with what makes up a fundable deal, so too there are basic elements around the how and why we invest in this space. And I would really encourage all of the investors out there to ask themselves, why is it that you invest in these types of opportunities? Is it for personal satisfaction because as an angel you want to stay involved? Is it as a corporate entity because you want access to strategic products, technologies, and innovative people? Or is it for economic development where you're looking to actually get high-paying jobs in your local jurisdiction? At the end of the day, if you're not investing because of return on investment, your investment thesis is going to be unsustainable. You'll have capital going out and very little coming back in. In terms of validating your answer to yourself as to why, really ask how you go about investing. Are you looking at due diligence in a very serious manner? Are you looking at the total capitalization of an opportunity and prepared to invest over the life cycle of the deal? Do you think about diversification of a portfolio? These are really critical things. And I would encourage you that as you go about analyzing why you're doing it and how you're doing it, look to professionals to assist you. Whether this is you're, in fact, deploying capital into a venture capital fund, it's joining up with additional angels to form groups that may tap into sophisticated resources for helping you on your due diligence and such, or it's looking at your professional advisors, their solicitors, your accountants and such that can help you in this. But this becomes very critical in terms of helping you make decisions. I appreciate the time today, and just to kind of wrap it here, I would say that all of this really is very elemental, but none of it is very easy. Thank you.
Okay, thanks very much indeed, Andrew. And Andrew and I are catching up later today to talk about how One Nucleus can work even more closely with life science ventures for member benefit. So our third speaker this morning